Ya, Assalamualaikum warahmatullahi wabarakatuh. Good morning, and friends. Today we are from Group 2, from Advanced Financial Accounting 2. The members of the group is the first is me, Olivia Riana Putri, and the others is Musa Kamal, and Mifta Mujana, and the last is Sakoto Muhammad Piniapon Sarah Linda. So today we would like to present the materials related to P15-17. So, in here is the partnership of Jordan and O'Neill began business on January 1, 2007. Each partner contributed to the following assets. The non-cash assets are stated at their fair values on January 1, 2007. So, the cash for Jordan is 60,000 and O'Neill is 50,000. Inventories for Jordan 18,000, O'Neill 0. Land for Jordan 0, and O'Neill is 130,000. For the equipment, Jordan is 100,000 and O'Neill is 0. So the land was subject to a $50,000 mortgage, which the partnership issued on January 1, 2007. The equipment was subject to an installment not payable that had an unpaid principal. So for the amount of $20,000 on January 1, 2007, the partnership also assumed this not payable. Jordan and O'Neill agreed to share partnership income and loss in the following manner. For Jordan, interest on beginning capital balance 3%, salaries $12,000, and remainder 60%. For O'Neill, interest on beginning capital balance 3%, salaries $12,000, and remainder 40%. So for the required, for the part A will be explained by Linda. For Linda, time is yours.
Thank you, Olivia. So I'm going to start with the journal entries. Can you please make the screen bigger, the file bigger, please? Okay, thank you. Wait, you can load it down now. So first of all, we are going to record the formation of partnership. So we are going to debit cash of 110,000. So we add Jordan's and O'Neill cash that Olive already mentioned above. And there is also inventory of 80,000, land of 130,000, and equipment of 100,000. So in the credit part, we have the mortgage payable of 50,000, also the installment note payable of 20,000. Also Jordan capital, as you can see here, is 60,000 plus 80,000 plus 100,000 and minus 20,000. So we have 230,000, and finally the O'Neill capital, which is 50,000 plus 130,000 plus minus 50,000, so we have 130,000. Next, please. So for the first one, we are going to record the purchase of inventory. So in this case, we are going to debit inventory of 30,000, and then we are going to credit cash and accounts payable. So for the cash, we have 24,000 and accounts payable of 6,000. Next, please. So the second part, we are going to record payment of principal and interest in mortgage. So we have mortgage payable and interest expense as debit. So mortgage payable is 5,000 and interest expense is 2,000, and we are going to credit cash of 7,000. Third is we are going to record payment of principal and interest installment not payable. So in the debit side, we have installment not payable and interest expense. Sorry. So for the installment not payable, we have 3,500, and interest expense we have 2,000, and we are going to credit cash of 5,500. Sorry. Next, please. So for the fourth section, we are going to record sales. So in order to do that, we are going to debit accounts receivable and cash. For the accounts receivable part, we have the amount of 21,000, and the cash we have 134,000. So for the credit part, we have sales of 155,000. In the fifth part, we have the journal of a way to record the selling and general expense, where the selling and general expenses are known as a debit with the amount of 34,000. And for the credit part, we have cash and accrued expense payable. So for the cash, we have 27,800, and accrued expenses payable, we have 6,200. Next, please. Now we are going to record the depreciation expense. So in the debit part, we have depreciation expense of 6,000, and in the credit part, we have accumulated depreciation with amount of 6,000 also. In the seventh part, we are going to record drawing of the partner. So we have first Jordan drawing. Jordan drawing in the debit part, sorry, of 200 times 52 weeks. So we can have 10,400. We also have O'Neill drawing with the amount of 10,400. So in order to match everything, the credit is we are going to credit cash of 20,800. Next, please, we are going to sorry, record sales. So in the debit part, we have sales of 155,000, and we have income summary in the credit part of 155,000. So in the last part, we are going to value the net income and close account. So we have first the cost of goods sold in the debit card of 90,000, and inventory in the credit part, sorry, of 90,000. So in order to get this amount, we take first the beginning inventory of 80,000, and we add purchases of 30,000, and finally we less it with ending inventory, so we got the amount. Now we move to the next journal, where we debit income summary of 134,000. We credit cost of goods sold of 90,000. Also selling and general expenses of 34,000. Also depreciation expense of 6,000, and interest expense of 4,000. Can you please go down? Okay. And then next journal, we have income summary in the debit part of 21,000. And in the credit part, we have Jordan Capital and Omni Capital with the amount of 10,500 each. And finally, we have Jordan Capital and Omni Capital in the debit part with the amount of 10,400 each. And in the credit part, they have Jordan drawing and O'Neill drawing, which is also the amount of 10,400 each part. Next, please. So here we have the schedule in order to allocate partnership net income for 2007. So as you can see here, for the profit percentage, Jordan has a 60%, O'Neill has 40%, and so we have the total of 100%. So the beginning capital balance, we have 220,000, as we calculate before when I mentioned the first journal entry that I mentioned before. And for Only, we have 130,000, so the total is 350,000. So net income, we have the revenue of 155,000 minus the expenses of 134,000. So we have the total of 21,000. And when we talk about interest in beginning capital balances of 3%, we have for Jordan, we have 6,600 and Only of 3,900. So the total is 10,500. So we minus it with the net income, so we can get 10,500. And now we have the salaries. For Jordan, it's 12,000, and for Only also 12,000. We have the total of 24,000. We minus it with the 10,500 that I mentioned before, so we got minus 13,500. And then there is the residual deficit of minus 8,100 for Jordan and minus 5,400 for Only. So we can get 13,500 also. So the total for Jordan, we got 10,500, and also for Only 10,500, but since we minus the amount that we got from the subtraction of the salaries with the residual deficit, so we got it 0. So that's all for my presentation. Thank you for your attention.
Okay, thank you, Linda, for the presentation for the part A. Next is part B, record the income statement for the journal Jordan O'Neill partnership for the year ended December 31, 2007. That will be presented by me. So for the income statement, for the year ended December 31, 2007, in the first sales, we got $155,000 and less of cost of goods sold, which is inventory in January 1, $80,000 and purchase $30,000. So for the goods available for sale, we got $110,000. And then less inventory in December 31, which is $20,000. So for goods available for sale and inventory in December 31, we got is $90,000. For the gross profit, we get it from sales minus inventory in December 31, which is 155 minus $90,000. We get it $65,000, and then with less with selling and general expense, $34,000, and depreciation expense, $6,000. From that, we get it $40,000. And operating income, we get it from gross profit, $65,000 minus $40,000. We get it $25,000. And non-operating income interest, operating income minus $40,000. So for the net income, we get it $21,000. For the next part C will be presented by Miftahul, and it's yours.
Okay, I will present the C part. Prepare a balance sheet for the Jordan O'Neill partnership at December 31st, 2007. For the balance sheet, the first part is asset. So the cash, here we got 158,000. The cash, we got the calculation from the beginning balance, 110,000 plus sales, 134,000, minus inventory, 24,000, minus mortgage payable, 5,000, minus interest in mortgage, 2,000, minus installment notes payable, 3,500, minus interest on installment not payable, 2,000, minus selling and general expense, 27,800, minus J capital, 10,400, and minus O capital, 10,400. So we got the cash 158,000. For account receivable is 21,000, and for inventory is 20,000. We got it from the calculation beginning balance plus purchase minus cost of goods sold. And for land, we got 130,000. For the equipment, we got 9,400. So we got the total asset is 423,000. For liabilities and capital, here we got accounts payable is 6,000. For accrued expense payable is 6,200. For installment not payable, 16,500. For mortgage payable, 45,000. So we got the total for liabilities, 73,700. For the capital, for Jordan capital, is 220,100, and O'Neill capital is 130,100. So we got the total capital 350,200. So we got the total liabilities and capital is 423,900. For the next explanation will be explained by Musafa.
Yeah, I want to present last part and prepare the journal entry for the admission of field on January 1 and 28 and the investment into the partnership, the 90,800, prepare your partner capital and 3,500,200,000 and the total capital of the new partnership and 4,500,000. This capital credit 0.20 times 4,500,000 is 90,000, and the bonus allocated to Jordan and in the ratio 16 or 15 in the 9,800 and in January in 28 journal entry and the cash in the 90,800 and Jordan capital in the 16 times 90,800 is 50,000 800 and on your capital 14 times 90,800 is 30,000 9,200 and the real capital is 90,000.
Okay, so that's all about our presentation related to problem 15-17. Thank you for all the attention. Assalamualaikum warahmatullahi wabarakatuh.